Well, good morning, everybody. Welcome. I can see the participant number is building as everyone's still making their way in, but we will kick off and get started. Thank you very much for joining us for AP Group's introduction for Junior Partnerships webinar. I'm Chris Swifte, the National Sales Manager with AP Group, and I'll be hosting today's webinar session. To give you a little bit of background about myself, I've had a number of roles in the retail pharmacy sector for around about 25 years. Those roles have included product sales, some time with wholesalers, some time with retailers and franchise groups. And the last 4 years, I have been doing sale of business with AP Group across Australia. Now, before we get started, I would like to acknowledge the Bunurong peoples of the Kulin Nation as the traditional owners of the lands on which we conduct the webinar today. We pay our respects to their ancestors and descendants who continue cultural and spiritual connections to country. As I mentioned, welcome everybody for attending today's webinar titled Introduction to Junior Partnerships. In recent times, the partnership space in retail pharmacy ownership is really growing and going from strength to strength. We're seeing considerable growth in that area through growth in our database and also through opportunities that are coming onto our website, and we're going to be excited to talk through that today. There are some great opportunities for both existing pharmacy owners and aspiring owners, so we have developed this webinar to educate and bring awareness to the program. At the conclusion of the webinar, we'll be taking time to answer any questions that you may have. So please, if you have any questions, you'll notice on the bottom of your menu bar, there is a Q&A tab. Please just submit your questions through there. We'll try and get to as many questions as we can throughout the session. So you're welcome to submit those. Now, today's experts we have lined up for you are Stuart Ellis, AP Group State Manager, Queensland, Andrew Whelan, GM, AP Group, based in Melbourne, Nicholas Galle, Legal Director, AP Legal. And without any further ado, I'll get into the agenda. So the agenda for today includes four sections: the introduction to junior partnerships, the financial considerations, legal considerations, the program process. So I'd like to get it all started and introduce the first section. I'd like to introduce Stuart Ellis. Stuart is AP Group's Queensland State Manager. He's a very experienced business owner and pharmacist with over 20 years experience. Stu is well equipped to talk about junior partnerships, having started his journey in ownership as a 50% partner, and he's currently owns 4 pharmacies in Queensland that all operate under a managing pharmacist partnership structure. Welcome, Stu.
Thanks, Chris.
In your experience, can you tell us how partnership opportunities come about?
In my experience, most of the time, it's existing owners looking to take a step back from the day-to-day running of the business. So that might be to focus on other pharmacies that they own, or just other investments, or it could also be for lifestyle reasons. They might be looking to just have less stress in their life and more free time. Sometimes we do see an owner of the business recognise that they've got some real talent in one of their employees. And in order to keep them with the business, sometimes they offer a share of ownership in the pharmacy as an incentive to keep them engaged. And other times we see a pharmacist who currently works in the business just approach an owner directly and ask to purchase a share in the business.
Thanks, Stu. Well, a lot of owners are always looking for like-minded business partners. So what are the first steps that someone can take if they would like to become a junior partner?
Well, in some ways, it's a lot like buying a house. You need to decide what style you want, a new build versus a fixer-upper, or, are you interested in big box discount pharmacies or more professionally focused pharmacies? And then I think the next step is to educate yourself on the financial metrics of those different styles of pharmacies. So become familiar with what profitability looks like for those pharmacies, the rent as a percentage of turnover, wages percentages, the mix of sales, etc. And then from there, you really want to become aware of the opportunities that are out there in the market. And I'd recommend signing up to the AP Group website to gain a good understanding of that. And from there, it's also worth developing an understanding of how pharmacies are valued and how the prices are arrived at. Most of the listings on the AP Group website have a valuation conducted by an independent third party that will help you get your head around the valuation process. And I'd also suggest financially putting yourself in a position to act when the right opportunity comes along. I'd start by talking to a specialist in pharmacy finance so they can assess your borrowing capacity and start that conversation. It's also worth developing relationships with other pharmacy specialists such as lawyers and accountants.
That's a good point, Stu. We'll actually be expanding upon the importance of building relationships with industry experts as we go through the webinar today. So tell us, how can a junior partnership benefit from in a pharmacy business?
So junior partner often brings a new energy and fresh ideas to the business. And they often bring some skills that complements the existing owner's skill set. So for example, in my case, taking on a junior partner, I could bring on somebody that has more skills in the professional services area than I do, or they might have more skills in social media promotion. So that could really benefit the business. The other thing bringing on a junior partner can do is really free up time for the existing owner to work on the business rather than in it, or of course just free up time for your own personal pursuits. And another advantage I would see is that it's just good to have somebody else with some skin in the game who's motivated to grow the business profitably.
Well, yeah, every business owner, their key focus is to continue to improve the business and improve the profitability. So why is a partnership a great way to break into the ownership space?
Well, the good thing is that you're buying into an established business with runs on the board. It's a known entity, and you're going to benefit from the experience of the partner you're buying in with, who most likely has built that business up to the point where you're happy enough to buy into it, and you'll benefit from their guidance, support, and advice. The other thing that you'll benefit from is that you get to share the responsibility. So, if you do want to go on a holiday or you do get sick, you've got someone whose interests are aligned who will cover you there as well. And of course, there's also the offsetting of the risk. If things don't go 100% to plan, you're not 100% financially or operationally liable if things don't go as well as you'd hoped.
I think, yeah, as you touched on earlier, the education and continue to develop and work on your skills by working with other people like mentors and so on is really a great way to get experience. So what are some of the other key considerations when creating a partnership?
I would say that being in business is a lot like being in marriage, or a commercial marriage, if you will. So you need to ensure that you have shared goals and visions with your business partner and that you get along. So I'd recommend working together for a period first to make sure that's the case. It's also really important to have a clear written understanding of how the buy-in process will work. How is the pharmacy to be valued? What is the price going to be? And what are the timelines that are to apply? And because it's likely to be, a big commitment and a long-term commitment, you need to ensure that you're personally happy with the location of the pharmacy. Does that work with your family as far as schools and other commitments go? And the style of business you want to work in. If you're a really professionally focused pharmacist, then maybe working in a big box discount is not going to be long-term professionally satisfying for you. And finally, I'd say it's just essential that you have a partnership agreement. And what that will do is it'll set out the responsibilities of all the parties involved, how everyone is remunerated, and how drawings are to be dealt with, and also what happens if somebody wants to exit or you go to sell the pharmacy.
Thanks, Stu. I've got a couple of questions if we can quickly throw them at you. The first one I've got for you is how do you recommend that people learn about businesses, probably more about the financial metrics to measure?
Well, I think the AP Group website is a really good resource. Once you have access to it, you'll be able to go in and look over the profit and loss statements, the script analysis reports, and looking over as many different businesses as you can will give you a really good grasp and understanding of the key financial metrics of pharmacies.
Thanks, Stu. One more quick one I'll throw in. You talked about the valuations before. Who pays for the valuations, a junior or senior partner?
Sometimes there's already a recent valuation in place that might have been done for finance purposes, for example. So in that case, you just use that valuation. But if it needs to be updated or a new one needs to be paid for, then normally that's just split 50-50 by the parties.
Great. Thank you, Stu. We'll get to some more questions as we go through, but in keeping the momentum going, don't forget you can continue to submit at any time those questions. So thank you very much, Stu. I'd now like to introduce Andrew Whelan to talk us through the financial considerations. Andrew is the AP Group General Manager and Pharmacy Finance Expert, having been with AP since the beginning. Andrew's got more than a decade of experience in financing pharmacy purchases. He loves helping customers out with some of the biggest decisions they'll make in their lifetime, whether that be buying a home or investing in a pharmacy. And Andy really does enjoy showing clients what's truly possible. Welcome, Andy.
Thanks, Swifte.
In your opinion, what are lenders typically looking for when they're considering junior partnership applications?
Sure thing. So what we talk to here is there's really three key things that you need to be able to demonstrate to a lender. And if you can do that, you're well on your way to achieving approval for your application. So the first of those is who's actually borrowing the money, so the character of the borrower. The second is the security that you put up for the loan. Most commonly here we're talking about the pharmacy itself. And then third is your ability to repay the loan that you're seeking to take out. So you've got those three things that you need to be able to demonstrate to the bank. And then the fourth thing that we've got on the slide there is how you package that up and present it to the lenders. So what you say and how you say it is important, and that can have an impact on whether you get an approval in the first place, or also what sort of interest rates and repayment terms get extended to you by nature of the strength of your application.
The character of the borrower sounds interesting. Can you tell us more about that?
I certainly can, and it's one of the most important things I'll cover today. So this is really about who's borrowing the money, and is that person a trustworthy person for the bank to loan the funds to. And the first piece of it, we break it down into two parts. The first piece is around applicant experience. So can you demonstrate you've had experience in a range of different pharmacy settings, and you've had experience at management level activities like looking after a team or managing a P&L. In a partnership context, you're fortunate because you've also got the senior partner there who does have the runs on the board. And so the blend of that experience obviously goes into the application. So applicant experience is the first piece. The second piece is demonstration of financial management and conduct. And so you're on your own here. There's nowhere to hide with this one, and it's critical. So what this is about is being able to show that based on your past behaviour, you're likely to be able to manage a big loan, a pharmacy loan, moving forward. So most of us have had liabilities at some point in the past, whether that's a home loan, a car loan, credit cards. So being able to demonstrate that you've had those facilities and you've managed to meet the repayments on time and fulfill all of your obligations with that loan. So what you don't want is to have the odd payment default because you had the funds there, but it was sitting in another account. You just don't want any red flags on your conduct and your history. And it extends as far as your credit rating as well, and managing that carefully. So you don't want to be the kind of applicant that puts an application forward to the bank with a credit rating that's been affected by the fact that you moved house back in 2022 and you left a bunch of electricity bills unpaid. Those small things do really add up. And I'll probably, just to round out this section, what I would say is we've got a number of clients who tick this character box. And once you've got the faith of the bank that you're a person of good character and you've got the ability to execute on a business, there's no shortage of support out there. It really does open up massive possibilities. And obviously, conversely, if you don't have that, it's a huge inhibitor to what you'll be able to achieve with being able to seek finance for your projects.
It's a good description. I like you talk about the building of a financial resume or a CV as such. Can you expand upon capital and the level of funds available to borrow?
I can. And so what we've got here is an overarching example. So what we're referring to here is what actually secures the loan that the banks extend to you. So most banks will assign value to a pharmacy based on the lower of either the purchase price or the independent valuation. So in this example here, you can see on the left-hand side of the slide, we've got a pharmacy that's sold for $2 million and the independent valuation has come in at 1.9. So the bank attributed value, or what the bank will lend money against, is that 1.9. I'll pause here just to note that most commonly, not always, but most commonly for junior partnerships, we do see the purchase price and the valuation aligned. But I did just want to highlight that discrepancy and how that works. And so then if we look over to the right-hand side of the slide, then how much money can you actually borrow against that asset that you're putting up for the loan? Again, I stress each pharmacy and each application is different, but we'll give you some general rules of thumb. So 75 to 80% of the value of the pharmacy is typically what you can borrow in bank funds, which then leaves 20 to 25% that's got to be contributed by the applicant by way of cash, or if you've got property equity there, you can potentially borrow that 20 to 25% against a property asset as well. So that's how it works in an overarching sense. And what I'll do now is just give you a couple of examples of how that works in a partnership setting. So you can see here, the example is we've got a pharmacy that's worth $2 million. In this instance, we're saying the valuation's aligned to that. So $2 million valuation, and we're purchasing a 25% share. So the simple maths of that is it's $500,000 to purchase the share. There's a couple of options that we'll run through for how that could come to life. So the first is that you leverage equity in the pharmacy. So in this example, the entire $500,000 share could be purchased, it could be borrowed and secured by the pharmacy. So the junior partner has a loan of $500,000 to facilitate that purchase. Now, the key thing here is that the maximum lending on the business doesn't exceed that envelope of 75 to 80% LVR. So if you've got a senior partner who's held the pharmacy for a while, paid down debt and built up equity in the pharmacy, this option can be available pending agreement from that senior partner. And I must say it's one of the more common approaches that we see for junior partners buying into a pharmacy. So that's option one. Option two is where the junior partner funds their share of the deposit. So in this example, $500,000 purchase, the junior partner takes out a loan of 75%, which is $375,000 that's secured by the pharmacy. That obviously leaves them then with $125,000 still to find. So that could be made in cash if you're fortunate enough to have those cash reserves, or if you've got another asset, property is the most common, and you can borrow against that asset, then you could potentially have a scenario where you've got $375,000 loan secured by the pharmacy, $125,000 loan secured by your own property, and again, you're fully funding the purchase. That's a couple of the options. There are more, but they're the ones that we'll shine a bit of a light on today.
Thanks, Andy. We've got quite a few questions coming through, which we'll get to shortly. Can you talk about, does having a high level of personal borrowing impact your ability to get a loan to purchase a share of a pharmacy?
It can, yeah, it can. So what I'll do now is explain the capacity piece. That's the third of those three items that I mentioned on the opening slide, meeting the repayments for the loan, and that'll add a bit of colour to answer the question directly. So what the bank's looking for here is just most simply, can you meet the repayments for the loan that you're requesting? And the way that they'll assess that is they'll take all of your income, so which would be your wage for working in the pharmacy, your share of profit of that pharmacy as a junior partner, and any other income that you may have, whether that's rental income, by way of example. So they'll take all of that income and then take away all of your expenses. So less the repayments for the proposed pharmacy loan, repayments for any other loans that you have. So if you've got a property loan, a car loan, credit card commitments as well, even things like Afterpay is something we're seeing more and more of these days. So they'll look at all of those financial commitments you've got. You're obviously going to have a bit of tax to pay as well, so that'll get factored in. And then finally, your month-to-month living expenses to make sure that you can put food on the table, switch the lights on, etc. So they'll take all of that income, all of those expenses, and then look to see that there's a surplus at the end of it. And then a couple of key things to note within that. So they'll do that test. Banks will run that equation at stress test or affordability interest rates. Different banks do that slightly differently, but as a rule of thumb, sort of 8 to 10% is the range that banks will assess your interest rate at. And the intent there is just to make sure that you can still manage the repayments in the event that interest rates increase, as we have seen over the last couple of years. And then just to round out on your question directly there, Swifty. So if you're the person who's got multiple fully geared home loans, a couple of credit cards and a car loan, stands to reason it's going to be a lot more difficult for you when you approach a bank to ask for money for a pharmacy, because you've got to prove that you can service all of those facilities at stress test interest rates. So that's not to say that having any personal debt is a bad thing. Like having a mortgage, for example, does give you an opportunity to demonstrate your financial conduct and show that you can manage a loan facility, but it is worth being mindful of just how much of that personal debt you carry if your primary objective is to get into pharmacy ownership.
Thanks, Andy. That's very helpful. Can you talk us through the steps on the finance journey?
I can. And so the finance journey, we typically say you've got to allow about 8 to 12 weeks to get that piece of the puzzle completed. And that we consider in a broader context of getting from the point of purchase all the way through to settlement, which Nick will tell you a little bit more about in his section coming up. That's typically about a 6-month process. So this finance piece, 8 to 12 weeks in a bigger 6-month process. Step one, we always say, start with a capacity assessment, starts to put some stakes in the ground for what might be possible. And I'll say as well, we often do these with clients, and they may not be ready at that particular point in time, but what it does enable us to do is have a bit of a look and say, well, if the ambition is to buy a pharmacy at X value, here's where you need to get to in 12 months time or 24 months time. But that just puts a stake in the ground to be able to start the conversation. The second step, again, you'll hear more about this in the legal section of the presentation, but confirm your borrowing structure. I'll just give the quick example that if you're going to borrow in a company name, which is relatively common, one of the options that's available to you, let's say it's company ABC. It's company ABC that will be presenting to the bank and asking for the loan funds. So you need to be able to articulate what that structure is at the outset for the bank to fully assess the application. So step 3 is just agreeing with the senior partner what the actual funding or application will look like. Are you going to go for a fully funded purchase that's secured by the pharmacy, or something slightly different? That needs to be decided before your application gets pulled together. So step 4, Stu mentioned this a little bit earlier, the independent bank panel valuation. So this goes across to the bank and provides them with an independent view of the value of the asset. So you can complete that step in conjunction with steps 2 and 3, which we'd always recommend. But step 4 is obviously a key part of the process. And once you get through that, you're into preparing the application. And so this is where we look to pull together an application that meets the key things that the banks are looking for, and get that out in step 6 to as many lenders in the market as possible, so we can compare lender offers. So not every pharmacy will suit every bank. The most important thing here is to get as many sets of eyes on it as possible and create that competitive tension. So you're going to get some level of support for your application, but also there's a bit of competition there to be able to negotiate the best possible rate and repayment terms. So once you've nailed down which particular lender you want to go with. Then you go to the formal credit assessment with that lender in step 7, and hopefully through to an approval. And then finally, you're left with some loan documents to sign, and the finance part is complete, and you're moving towards settlement.
Thanks, Andy, for talking us through that sort of 8 to 12 week timeline of activities. In your experience, what are some of the tips for presenting your application?
So there's 3 key things we point to here. The first one, you've heard it earlier in the presentation, and you hear it again from me now. So just engaging a representative with pharmacy experience, whether that's AP Group or someone else, having a pharmacy experience broker is critical. So I'll talk about that 8 to 12 week process on the previous slide. If you're dealing with, let's just say it's the family mortgage broker who you've known and trusted for a period of time, if they're putting the application forward, the likelihood is they're not going to know how to present it in terms of what the banks are looking to see. And they're also not going to know which of the specialist health teams within the banks. They're not going to have those networks to be able to put forward the application to the right people. So 8 to 12 weeks can become a much longer period of time very quickly, or worse still, you don't actually get to the outcome of having the application approved. The second is canvass a range of lenders. So again, you want to make sure that you're getting out to as many banks as possible to create that competitive tension, to make sure that you're getting the best possible rate and repayment terms available to you. And then the third we say is make sure you get it right first time. And again, that comes back to having the right person prepare the application for you. But some of the worst stories we see is where an application goes forward to the bank with things that will pop up as red flags, and then you can't retract that and have the bank unsee it. So you only get one first opportunity to create the right impression with the lenders, and that's a key thing towards that we'd say towards getting the application right.
Thanks, Andy. Can you share some of the other key considerations for funding your junior partnership?
Again, yes, I can. You heard a couple of key considerations from Stu a little bit earlier in the call, and you'll get the legal ones later from Nick during his part of the presentation. But a couple of key ones for finance. So doing your due diligence, we mean that in a numbers sense, of course, like look under the hood and make sure the business is as it's presented to you. But also numbers don't tell all of the story. So you're going into partnership with someone, just like a commercial marriage, as we heard from Stu earlier. So making sure that the personality types you're going to be able to get along together and work together for a sustained period, and also understanding the store that you're buying into, what the demographics are, what the customer base is like, and making sure there's a really good fit there. The second is around expert advice. Again, I stress that doesn't just extend to having a pharmacy specific finance broker, but also an independent pharmacy accountant, and also a pharmacy experienced lawyer as well. Again, mentioned that 6-month process that it takes to get the whole settlement piece done. You really need the right people giving you advice to keep that 6 months, as short as it possibly can be, and not blowing out to longer periods of time. The third, and this is where partnership's a little bit unique, is that you've got to understand your obligations to your partner. So in the instance that you're buying a store by yourself, it's obviously all on you. But with a partner, you're taking on the risk of what that partner's financial situation is like, and vice versa. They're taking that same risk with you. So making sure you understand what those obligations are, and that you're choosing the right person to partner with. And then the last one I'd point to there is just the lifestyle impact. So with most pharmacy loans, the way they're structured, the early years are the toughest. That's when your loan's at its highest, the repayments are at its highest. So you've got that inevitable financial stress that comes with that, but also that lifestyle change of going from being, an individual contributor in a business to running the show and having all the pressures that come with that. So it also creates great opportunity, but it's just being aware of how that lifestyle shift, that lifestyle shift will come, and being prepared for it.
Thanks, Andy. I've got a couple of questions we'll run through. I won't be able to get through all of them. We heard quite a few in the finance bit. We'll do our best when we get to the question time at the end. But can you explain what LVR means?
I can. So LVR is loan to value ratio. So how big's the loan compared to the value of the asset? If I go back to that $2 million pharmacy example I was running with before, a $1.5 million loan is 75% of the value of the pharmacy. So therefore the LVR, in this instance, would be 75%.
And can you tell us through how you calculate goodwill?
Sure. So we're getting into, I guess, a bit of a valuation discussion there. So I won't delve too deeply into that, but what I would say is we'll send out an email after the session. And so for the person who asked that question, be very happy to address it. But it probably needs a bit more of a detailed conversation than answering on the webinar.
Yeah, great. We've actually had quite a few, so we won't be able to get to all of them. We'll continue on, but please keep seeing those questions through. Thanks, Andy. Appreciate you sharing your thoughts and experience on the financial considerations. Now we'll move into the next section, which is the legal considerations. We have Nicholas Galle with us to talk about that. So Nick is a key member of AP Legal with a wealth of experience in the retail pharmacy sector. Nick's main areas of work have been in the commercial space with property, handling over 500 pharmacy transactions, including sale of business, leasing, relocations, ACPA applications, and of course, partnership agreements. Nick's knowledge and experience within the health and pharmaceutical sector is unrivaled. Let's welcome Nick.
Thanks, Chris.
Nick, can you tell us about the legal agreements that are associated with partnerships?
Yeah, so the main document or main agreement that will govern a partnership will simply be the partnership agreement between the junior and senior partner. This agreement takes place at the beginning, and prior to entering this, you need to decide, how you're going to purchase your interest in the pharmacy. Would that be as you personally, as an individual, in your own name, or you as in a company where you're the sole director shareholder? The structure is usually advised by your accountant, who will propose what's kind of best from a tax point of view. This is in addition to any kind of, legal risk or liability considerations that you need to take into account. The more common structure that I see is people buy in with a company structure in place. The structure that you decide on at the beginning, it's quite important because this will follow you through on the journey of owning the partnership. That will be the entity, that completes the purchase. That'll also be the entity of which you need to apply for finance. So deciding on the correct structure at the beginning with good advice, it's quite important. And ultimately, this is the entity that will, carry the liability, hold the benefits in the operation of the pharmacy.
So what's the purpose of the agreement?
So overall, the purpose of the partnership agreement is simply to set out the roles, obligations, and responsibilities of the parties. Also, it's important because it documents, what actual interest or what actual ownership do you have. Other areas that the agreement will cover, some basic ones are, just general duties of the partners. This is pretty basic stuff. The parties need to act in a professional manner, must always comply with the law, things to that effect. The agreement will normally set out how decisions are to be made. Fundamentally, the decisions will be made depending on your, interest, how the percentage interest held in the partnership. But some decisions will require unanimous agreement. This is where something of more importance is needed in the partnership. So such as if you want to take out a loan or acquire additional assets. Otherwise, overall, decisions are normally just made, can just be made by the majority interest holders. Further to this, the agreement looks to set out kind of, how the pharmacy is to be operated on a day-to-day basis. So it can set out that this can simply be done by the junior or the managing partner who's working in the pharmacy, day to day. And, what are the requirements of this partner in working in the pharmacy? So, for example, they're responsible for stock purchases, responsible for rostering, managing staff, things to that effect. And then otherwise, just overall, the agreement will just cover off other items such as, how further capital or funds are to be contributed to the partnership if needed, from one of the partners, how profit distributions are to be made, and then just, otherwise, how expenses or the obligation that expenses of the partnership are to be dispensed of.
Do you include topics such as, how you can increase your ownership stake or percentage in the future into these partnership agreements?
Yeah, so overall, the agreement will provide, procedures, requirements to how any disposal or acquisition in the partnership takes place. Further to your point, for future purchases, let's say from a junior partner point of view, yeah, it can set out how they can acquire additional shares. I'll commonly see things like, after a 3-year period, the senior partner will offer another 10%, then another 10% in an additional 3 years, something to that effect. Or otherwise, sometimes there's just provisions will be there for a complete exit of the senior partner, such as in 5 years, the junior partner can buy them out. In addition to kind of covering how those purchases can be made, the agreement will usually set out how these future interests are to be valued and what are the procedures surrounding that. So the most common one will simply be that, you need to obtain a valuation, and then, you'll set the purchase price for the interests from there. To kind of protect, we'll say, the existing partners from moving forward with future purchases and how those look, the agreements we normally include something called a first right. And the first right, it obligates an exiting partner or a partner that wishes to sell their share, it obligates them to first sell that share to a partner that's going to remain in the partnership. So this at least provides some security moving forward as to your right that you will have the ability to buy additional shares, or an additional share, additional interest within the partnership. And then I guess just finally, the agreement normally will look to how new partners are to be, to enter the relationship. It's normally just by unanimous agreement of the parties.
And what happens, Nick, if there's changes or conflicts in the pharmacy partnership, into the future?
Yeah, so ideally, this doesn't take place, but things happen, and if a dispute arises, or the relationship begins to break down, the agreement will, firstly set out a dispute resolution process for the parties to follow. This is kind of necessary even where there's potentially just disagreements. But then, more importantly, the agreement will cover off, what happens if a partner is genuinely just in default of its obligations or refusing to complete or comply with its obligations, under the agreement. What happens from here? So potentially dispute resolution process is the agreement will also set out what triggers the ability for the parties to terminate the agreement. And again, what happens from here? What happens to the business? What happens to funds? How does, what does this look like, or what's the process from here? The agreement can be turned to provide some type of, clarity or structure. It can also, govern the ability here of, when a third party if that was necessary, or otherwise it at least simply defines what are your rights, and how can these rights be enforced. So it's not always just, from a dispute as well. The agreement will normally set out how a party will just simply exit or retire, more likely in the case of the senior partner, or if a partner's unable to work or passes away. Again, what are the mechanisms here for an exit if something like this occurs? And again, what are the valuation processes involved, for that exiting partner's share to potentially be purchased?
So what are the risks, Nick, of not having a partnership agreement in place?
Yeah, so a partnership agreement will be needed anyway, just simply because any change of ownership, the state regulatory bodies require one. But even if that wasn't the case, without an agreement in place, it's limited to what your rights actually are, and there's limited certainty as to what are you entitled to, what rights do you have under the agreement, or it doesn't provide any framework for the event that the relationship does break down. Someone wants to buy additional interest, someone wants to sell. It provides a structure, for the partners moving forward.
Thanks, Nick. So how do you work through the scenarios with the sale of business and a partnership scenario?
Yeah, so these will normally occur concurrently in terms of, you know, them the agreements and the documentation being prepared. But the way to think of it is, you know, the contract and the sale takes you from initial offer to settlement, where, you know, money exchanges hands, and, you know, you acquire some ownership in the assets, or the pharmacy, sorry. The partnership agreement effectively operates from the settlement date and ongoing through the remainder of the journey of your ownership of the pharmacy within that partnership. In the sale of business process, you know, this must take place first. Sorry. The key steps are, you'll have the contract of sale. So again, a contract needs to be prepared. Important, you know, because this actually sets out what you're buying, and, you know, includes a sale price, and this is signed and agreed to by the parties. The next step will be a transfer of the lease to the new partnership. So this, you know, will involve the landlord at the premise. It's important to understand that this obligates, you know, you, the partnership, under the lease now, but it's also important, you know, there's important steps as required, because it secures your tenancy rights, or you know, it ensures that you've got the right to occupy the site where the pharmacy is located. Then finally, the next major steps will be just, you know, your state's regulatory body. There'll be a change of ownership process to that of the new partnership from the existing partner. There's also a change of ownership process with the Department of Health to put the PBS number in the name of that new partnership. Again, both these steps are needed. It secures your ownership in the pharmacy, but also ensures that you can actually conduct a pharmacy, or more importantly, a PBS pharmacy. Overall, this process from, you know, let's say initial offer to settlement is roughly around 6 months. This is why it's important to have, you know, pharmacy specialized advisors, you know, because the process itself can already be quite lengthy, and this helps to kind of minimize any delays that there may be.
Are there any other steps in the sale of business in your partnership process?
Yeah, so then just overall, I guess in the background, or again, working, you know, somewhat prior to entering the contract or pre-offer, there'll be due diligence, which you should complete or might complete. Again, pre-offer stage, used to just simply verify the financials of the business. The other main step that, as Andy's gone through, is your finance application, which again, a step that should be investigated kind of, you know, pre-offer stage, pre-contract stage.
Thanks, Nick. I've got a couple of quick questions on legal. If you could assist with explaining the difference between a partnership agreement and a sale of business contract.
Yeah, sure. So I guess just very quickly, the sale of business agreement, it's similar to like when you buy a house. It's the government, the document that sets out, you know, how you're actually acquiring the interest, the rights that you're buying, what you're buying, and for what price. The partnership agreement governs the relationship between the partners after you've acquired the asset. So it's kind of operationally moving forward, you know, the relationship there, how funds come out of the business and so on. The contract to sale is just the initial stages for you to actually, you know, purchase your interest in the pharmacy.
Great. Thanks, Nick. I'd like now to invite Stuart Ellis back to talk us through the partnership program. So, Stu, where should a pharmacist start their journey?
Okay, so first thing to do would be to visit the website, apgroup.com.au, and register if you haven't already. From there, someone from the team will reach out to you just to have a chat with you about where you are at on your pharmacy journey. And we'll discuss things like, you know, what type of pharmacy would you like to buy? Where are you looking to buy? You know, are you looking to stay in a metropolitan area? Are you willing to relocate to a rural area? Are you looking nationwide or just within one state? So we'll get an idea of that. And we'll also start to commence that finance capacity conversation. So we find out how much you can borrow, how much deposit or equity you need to buy the pharmacy that you're interested in. And then if we just go on to the next slide. So once you have registered, log in and check out the opportunities that are on offer. We currently have a couple of great partnership opportunities on the AP Group website. And we do have a few more in the pipeline that will be going live soon. We're seeing a lot of growth and interest in this partnership space, so it's worth checking back regularly to see what's new. And just keep an eye on your emails as well for notifications of new opportunities. And if we just go to the next slide. So yeah, it's also worth noting that we have a news page with useful industry-specific content, articles and podcasts. There's lots of great information on this website to keep you abreast of what's happening in the business world of pharmacy.
Thanks, Stu. I'd like to take you through some of the key takeaways from the content that we've covered today. I think it's been very important and mentioned a number of times the importance of pharmacy experts that include, accounting, finance, and legal representation to ensure you're getting the right advice from people who have good industry knowledge. Another key point that's come up a number of times is about the finance capacity and conducting a finance capacity assessment to gain knowledge on your financial position, and the consideration of the sort of structures that you're looking for, the type of entities that you're looking that might be the best fit for you, and also identifying some of your key strengths and also some of the styles of pharmacy that are of interest to you, with a number of different choices around, and if you identify some of the strengths that are in good place, then obviously identify some of the areas that you need to improve your knowledge on is a key piece. Let's get to a couple of questions. I've had quite a few come through, so some of them are quite specific. So the ones that are specific, someone from the AP group will actually be in touch with you to go through them in further detail. Andy, if I could ask you a question in relation to finance, are there any scenarios where you have seen borrowers get more than 80% of the LVR?
Yeah, there are scenarios. So there's one of the examples that I mentioned in the body of my presentation where, as a junior partner coming in, if you're buying into a pharmacy that has available equity that you could fully fund or borrow 100% of your share of the pharmacy, provided that the overall gearing for the pharmacy is within that 75 to 80% envelope. So that's actually quite common. Beyond that, there are other examples as well where you can access more than 80%. So one would be if you've got property equity to borrow against, that gives you a sort of a second asset to borrow against. But even beyond that, there are certain lenders in the marketplace that will go a little bit above 80% depending on the circumstance. I guess probably what I would say is generally where there's a will, there's a way. So we would always say just have a conversation with us so we can start to plot out what might be possible. At the very least, we can give you something to work towards if the time isn't right now.
Thanks, Andy. Well, I've got you as well. The other one is can vary a little bit, but do your best to assist with what you, in your experience, usually see as a percentage being presented to a junior partner, and can that be negotiated?
Yeah, sure. So it can vary as you would expect, and often it's going to be contingent on what the senior partner is actually looking for. We've seen in the deals that we've done a first purchase of 50%, all the way down to a first purchase of 10%. Obviously, your pharmacy values will vary greatly, so that 50% and 10% could look quite different depending on the value of the pharmacy. But this is getting a little bit into Nick's space of the presentation now. But also just having sight of, if you're buying in at 20%, for example, well, what does that look like in year 3, 5 and beyond? So, having a plan with your senior partner to see, will there be opportunity to acquire more of a share down the line so you don't sort of get stranded on that 20% or the figure that you're buying at.
Thanks, Andy. So as I mentioned, some of those other questions we'll get in touch with people direct. I'd like to close up now by saying that we will be emailing out a copy of the presentation later today, and we also will have an option there if you wish to have a financial assessment a financial capacity assessment done, reply to that email and we'll make contact with you to assist with your borrowing capacity assessment. Please fill out a survey that we're sending out. We'd really appreciate everybody's feedback so we can continue to make the best quality, informative and educational webinars possible. We're really excited about presenting our experts to share their knowledge. So if you could complete the survey, that would be great. And I would also like to give a huge thanks to the expert panelists that have given their time up today. So thanks to Stuart Ellis, Queensland Sales Manager. Thank you to Andy Whelan, General Manager. And thanks also to Nicholas Galle, Legal Director. And from me, Chris Swifte, thank you for your time in attending our webinar.